Ladies and gentlemen, open banking pioneers, hello and a very warm welcome. Thank you for joining us around our campfire, where today we'll be discussing the poverty premium, looking at open banking use cases that deliver real impact. So let's start by getting a common understanding. Let me share what we mean by the poverty premium. It's a phenomenon where around the world, people on low incomes tend to pay more for essential services. Now, it does beg a belief that we actually need to have this conversation, but truly we do. Now, I would like to clear up one common misconception. The poverty premium isn't actually caused by financial poverty. It's caused because people on low incomes create less of a paper trail. Maybe data poverty would be a better descriptive. Now, we've all heard the appalling stories that link data poverty and higher prices for energy pricing. And that's just one example that's headlining in the news right now. Look, if there's less of a paper trail after a thin file in a system that's based on historical risk factors, you look like a riskier bet. And all the best deals in town are available for people on long-term credit-based contracts. How is that fair in an inclusive society? Now, we're going to be looking at how open banking can address this because it uses transaction history to fill in that data gap. So using data that's provided securely and importantly with consent from people's bank accounts to give potential lenders transparency. That's the key word, transparency on whether you're risky or not. So it's an affordability assessment, your ability to pay in the future. Now that's the key fact to establish. Around our campfire today, we've leading industry voices that will share with you a very strong argument that open banking can and does solve this issue, whilst at the same time, they're all running profitable and sustainable businesses. So proving that people on lower incomes are perfectly creditworthy in the right circumstances. The poverty premium isn't just related or limited to financial services. The same open banking data principles apply to other sectors, and we'll be hearing from Money Hub and the work they're doing with Voxy, and this is an absolutely fascinating use case. I promise to keep my intro really short so you'd have more time to hear from our panel of experts. Now, before I pass the mic, please can I encourage you to look at the bottom of your screen. Now you can easily make an open banking charity payment, real social proofing of how fast, secure and easy open banking is to use. Go on, please, lift up your phone and scan in that QR code. I am delighted to introduce you to our guest host, Laura Noonan, Financial Regulations Editor at the FT. Laura is going to start with a fireside chat with Jamie from Plend, then move seamlessly into debating this hot topic with our panel. Now, if the speaker's briefing call is anything to go by, Laura will be drilling down into the data to establish the facts. I believe you're about to hear a world-class debate, challenging, and at times we like a little bit of provocation. So please do get involved. At the side of your screen, you can see how to send in your questions, which Laura will put to the panel at the end. And you can also get involved with our Slido question, and we'll be sharing that on social media. And the question is, how, by moving to open finance, will this impact our ability to do more in this sector? So without further ado, Laura, it is my absolute pleasure to pass the mic to a female. Over to you.
Helen, thank you very much for that very fine send up. The one thing I will just clarify is that we are not going to make you wait until the end for your questions. I'm very happy to take questions throughout, as is the panel. So as you have a question, please do send it in to us. Okay, Jamie, I'm going to call you now to our virtual stage. Maybe you could kick off by telling us what it is that Plend actually does and how you guys leverage open banking to really open up credit to people who maybe typically can't access it.
Sure. Okay, cool. So Plend is a lender in the UK, and we have built our own open banking engine from scratch, which basically means we pull in every person's open banking data, your bank transaction data for the last 12 months into our application process. And it allows us to give more affordable rates than our customers can usually access. And crucially, it allows us to lend larger amounts of money than they could usually access. So when we're talking about financial inclusion, it's not just about the APR in the loan that you can access, but it's also about the size of the loan you can access and the length of time that you can access it for.
Okay, and thanks, Jamie. And for those who aren't familiar with the UK marketplace, how long has Plend been doing this, and how long has open banking data been available for?
So Plend, relative newcomers. We've been lending for about a year now. So yeah, still new on the scene, but doing very well. Open banking has just hit its 5-year anniversary. So yeah, it's starting to become a slightly more mature tech now.
And in terms of making credit more available, what kind of difference are we talking about? Are we talking about, say, going from an interest rate of, say, like 20% to an interest rate of 16%, or is it more a magnitude of like 20 to 5?
Yeah, so it's a really good question. So when we're talking about financial exclusion and what that means in the UK, the PwC study from last year, so there's about 20 million people in the UK, a huge amount who are basically financially underserved, which means they can't access prime products, the best products in the market. So the best products in the market are from the traditional banks. So, you know, you go to Barclays and you can get a smaller amount, you know, so something like £5,000 for single digits, you know, maybe 8-9%. That's a really good product right now. Or you can get a much larger amount, around £50,000, you know, top limit for slightly more. So that's if you're prime, the very best products. Yeah. The problem is the options. If you are not in that prime bucket, what the industry kind of quite offensively calls the subprime space, essentially the options get worse quite quickly. So basically your next best options beyond that are usually overdrafts and credit cards. So usually around the sort of 35-39% mark. And, you know, when you start to get into the payday lending space, you know, some of the really predatory lenders can be anything up to, you know, 80, 100, 300%. So, you know, when it comes to Plend and what we do, the average rate we lend out at is about 17-18%. And people who come to us, the overwhelming reason they come to Plend is actually for debt consolidation. So they have existing debts, often overdrafts, credit cards, you know, around about 39%. And they're coming to Plend and they're taking all of those outstanding payments and putting it into one affordable lump sum. So that's really the sweet spot. And during the cost of living crisis, it's one of the few things that you can really do to reduce your outgoing payments. You know, you've got someone like Martin Lewis on the radio being able to say, you know, I don't have any more deals for you. There's no energy bill switching you can do to, you know, save money at this stage. So debt consolidation, taking those expensive outgoing commitments and bringing them into one lower amount is one of the best things you can do to reduce your outgoings in the cost of living crisis.
So I guess if I were your chief risk officer, what I'd be saying to you is, how do you know these people are going to be good credits? How can you be confident that these people who have maybe taken on debt, which isn't the wisest, and they have to bundle all that debt together, are going to be able to pay you back? And you're only a year into the journey. So I guess you're possibly still finding that out. But what gives you confidence that the data you can see through their open banking profiles means that you'll get your money back?
So open banking is great as a contrast to bureau data because it's an incredibly intimate portrait of your life in the last 12 months, right? Everything that you've earned in the last 12 months, everything you've spent in the last 12 months, you know, how much you earn from your salary, whether you pay your rent and your bills on time, how much you're spending on your essentials like your groceries, you know, your utility bills, and how much SIM allowance you've got in your disposable. So your takeaway, your holiday spend, you know, that sort of thing. So essentially what you have with open banking data is an incredibly intimate portrait of someone's recent life. And essentially the whole strength of open banking data is in saying, look, actually that's far more predictive in telling you, especially in the current economic climate where everyone's situation is changing very, very quickly. You know, just because they were able to repay credit in, you know, the last 5-6 years, which is what what bureau data is telling you, doesn't necessarily mean that in this very different cost of living crisis, they'll be able to pay you back, you know, over the next 1, 2, 3, 4 years. And actually a much closer look at your more recent history is a far better way of assessing the risk of whether or not someone will pay you back or not. And actually, when you combine the two, which is what we do, so although we love open banking data and we're big advocates for it, we do use a blend of the two, right? So it's best of both worlds.
So what's the profile of the kind of person who typically comes to you? I mean, we've talked a bit about them using you to consolidate debt, but can you tell us maybe about, do these people typically have jobs? Have they been in employment for long? Are they new to the country, or have they just started working? Have they got maybe previous debts and previous judgments that would make them harder for a traditional bank to serve?
Absolutely, yeah. So there's two kind of key elements to it. So one is what you call it the industry thin files, which basically means there's not a lot of credit data on that person. You can have a thin file for a few different reasons. You can be young, you haven't had a chance to build up your credit score yet, but maybe you're in a good job, you're paying all your bills and your rent on time, and you're a good person to lend to. It's just that there's not enough credit data to make the traditional case for you. You might have just arrived in the UK, and again, you've had a great job, for the last 6-7 months. Again, paying your rent, paying your bills on time, but basically completely invisible to the bureaus. And you might have had problems with credit. So impaired files is the other one. So maybe you had problems, but those problems, because the credit data goes back 6 years, maybe you had problems repaying a loan, 4, 5, 6 years ago, especially for a younger person, the amount you change over 6 years. I'm a very different person to who I was 6 years ago, and the idea that's still holding you back, that's a millstone around your neck. When you've got this rich seam of more relevant modern data to look at in someone's life, that's a sweet spot. So those are the kind of people who come to Blend. But it's honestly a really wide range. People always assume we talk about what Blend does. Oh, they must all be renters, but actually 40% of the people we lend to have a home. So it's so they've got a mortgage. So it's I'm
hoping that like 90% of them have a home, or else we're in a different end of the market. And just in terms of how you see people using Blend, I mean, the rates that you charge, like 17-18%, is obviously much better than what payday lenders charge, but it's also a far cry from the mainstream lending rate, 6-7-8%. So is the idea that Blend would be a stepping stone back to the prime credit, or to what you can get from a high street bank?
Yeah, absolutely. I mean, the dream situation with Blend, the reason why we do larger, longer term loans is, we're not looking to be a payday lender who wants repeat customers. We want to give you one large, long-term loan that puts you in a better financial position than when you started. So the dream situation is someone comes to Blend and exactly, all they could access before were these payday lending products, overdrafts, credit cards, and they get themselves into a solid financial situation by the end of that Blend loan.
Okay, thank you very much, Jamie. Now I'd like to bring in Lauren from Fair for All Finance, who hopefully we can get on the screen, I think possibly soon. Lauren, I wanted to ask you about how you see the role of open banking when it comes to the financial inclusion question more broadly. I mean, is open banking the magic bullet in terms of improving financial inclusion, or is it a more complex issue than that requires more nuanced solutions?
Yeah, thanks, Laura. I think we'd all love to think there was a single magic bullet, or even a few that would really help with tackling financial inclusion. So let's talk a bit about the customers who we're trying to serve and where open banking can make a difference. So Fair for All Finance, we launched our segmentation model of customers in financially vulnerable circumstances last year. We found there were at least 17.5 million people in financially vulnerable circumstances in the UK. I'm always clear to say at least, because our research was conducted kind of middle of last year, and we know since then, week on week, month on month, in the current economic climate, things are getting harder. More people are squeezed, more people are struggling. That number's definitely getting higher. And we found that within our 6 segments, there's 2 in particular: credit crisis families and forgotten families, where there's 7 million people who really struggle to access financial services and financial products in the way that most of us on this call would be able to do. So a lot of the work we've done at Fair for All Finance is in affordable credit. We're talking about scenarios where people who don't have any savings can't access £500 when the washing machine breaks, or £200 for the school uniform bill when that comes up every year or every few years. And where do people in these segments turn to access lending when they need that, when these kind of a critical life moments where a small amount of credit can make all the difference? We know that open banking can play a role there. Some lenders who already serve these customer groups have added open banking into their processes, and that's working really well. But there's a lot more that's required. So I think in terms of lenders who are serving these customer groups, we've seen 60 lenders exit the market since 2016. So 60 subprime lenders, mostly high cost lenders. We definitely don't want to see, we'd prefer to see low cost lending rather than high cost lending. But what we're talking about is 60 lenders gone who were at least a legal regulated source of credit. We're not seeing more lenders rushing to serve kind of a higher risk financially excluded groups. So my question is, how does open banking create the environment and the commercial models that means the most financially vulnerable customers can be served, and we can continue to do that in affordable and ethical ways?
Okay, thank you very much for that, Lauren. And when you think about what open banking has already done in this regard, and the other people on this call are going to talk us through in more detail how their companies leverage open banking to tackle this issue, do you think we're kind of approaching the limits of what open banking can do here, or are we more at an early stage of the journey, and actually over the next 5, 10, 20 years, we're going to really see open banking become a more powerful agent for change here?
I think we're at an early stage of the journey with a lot more that can be done, and part of that is going to be about reach. So there's organisations like credit unions and CDFIs who already serve some of the more financially vulnerable groups, amongst others, who are kind of excellent at understanding those customers and serving them, but might not have the technological capability as some of the organisations on this call. So one is going to be about, how do we get this technology kind of into the hands of more organisations in a way that fits with their business models and how they operate? And I think the other another part of that will be, there's the people on this panel today are kind of using open banking for good, which is great. And how do we see more of that? So how do we see the likes of Snoop, who I know are coming to, reducing costs even further for people? And how do we see there's some great work taking place in things like benefits calculators, where we can more proactively start to say, this person looks like they should be entitled to an extra £400 a month. And we're seeing a lot of that. There's 15 billion in unclaimed benefits annually, on average £400 a month per person who's missing out. How do we get more integration to say £400 a month for these customers is a huge amount that kind of makes a massive difference, potentially even stops them from having to borrow. So how do we get more organisations, whether it's lenders, whether it's current account providers, whether it's anyone, kind of using the power of open banking to really bring costs down and increase incomes for people?
And just, Lauren, when you think about the potential reach of open banking and it being a more meaningful solution to this problem, do you think that financial institutions, larger ones, are incentivized to use open banking in this way? Because if you can't access a loan, then you may run into overdraft, in which case you'll pay higher fees and higher charges. So do you think that the overall financial system is incentivized? And everyone on this call all assured me on the earlier prep call that they all want to do good work and that they're all in it for a good social purpose. It's not always obvious to me that everyone in the financial system is in it for a good social purpose. Some people are there to maximize profits. So do you think that there are sufficient incentives, or is it always going to be a small corner of the industry doing this? But actually most people, the current setup kind of suits.
Yeah, I think it's a great question, and I think you asked a good question to Jamie earlier about what does the chief risk officer say when you say we're kind of trying to reach more vulnerable groups or slightly higher risk groups. I think it does require leaders of financial organisations thinking in different ways. There is are we willing to do things differently, to kind of recognise that it's not just social good now, but improving the financial resilience of people now is a longer term play. You're kind of growing your customer base into different segments with a longer term view of what improving their financial resilience now looks like in 2 years, 5 years, 10 years. I think that's a step change from where we are now, which is having a balanced portfolio of profitable products, mostly targeted at mainstream customer segments, not financially vulnerable.
Okay, thank you for that. That was quite a diplomatic answer to that, but I appreciate the sentiments. Ian, I'm going to bring you in now. Hopefully we can get you on the screen in a second and you can tell us how you are contributing to solving this problem.
Hi Laura, thank you. Yeah, so I'm from Money Hub. where we want to help people be better off and for businesses to be more in tune with their customers by using the power of open banking, open finance, and open data. And a great example of this last year was our partnership with Vodafone for their Voxy program, where we've used open banking to essentially revolutionize the eligibility checking so that those on benefits can receive a reduced phone tariff by proving that eligibility during the sign-up process. They simply have to online give MoneyHub a one-off consent to access the benefit receiving bank account to check if they've been in receipt of government benefits over the past 8 weeks. We can then notify Vodafone if the applicant receives benefits without the need to actually share any data between the two businesses. So it's helping people get the same product for less in that example.
So how broad is the reach of that? I mean, how many people are you helping with that program, and how many people does MoneyHub help overall?
Well, I'm not limited to share the stats direct from Vodafone, unfortunately, but obviously pretty big company. But we reach across the technology business, we reach hundreds of thousands of end users. So we have our own direct to consumer app in the marketplace, and we also offer white label versions of products, and companies use our APIs to create their own open banking based products.
Okay, so the overall objective of what you do is basically you tap into the open banking data and you help package that in a way that's useful for other providers of credit services.
Exactly. It can be anything. It can be a range of services. As Helen was saying at the beginning, it doesn't just need to be financial services, because we generally believe in the power of data that open banking holds in order to make better informed decisions going forwards in all avenues.
And I guess open banking data is obviously very powerful, but with data like this also comes risk. So how much damage, or how big is the risk that a lot of this progress could be undone if there was one hack, if there was one leak of people's data online? How much could that destabilize the whole initiative around, because people are quite sensitive about giving people access to, I mean, as you say, this is highly personal, highly sensitive data about all their incomings and outgoings. So how do you think about the risk of hacks, the risk of leaks, and how that might affect the project going forward?
Well, I think if that was to happen, yeah, that would be a pretty dire situation. But I think the beauty of the technology in open banking is that you're not having to share really sensitive credentials in order to access the data. It's all highly encrypted, and you connect via secure authentication tokens in order to receive that information. And going back to like the Voxy example as well, it's a one-time share as well, and that data is never stored. It's all sort of seamlessly done in that one decision-making process.
Okay, thank you. James, I can see from the look on your face and also from the message that you shared in the chat that you would also like to come in on this point. If you could briefly tell the audience what Direct ID does first, and then you can defend the safety of sharing this kind of information online. Take it away.
Oh, thanks. No, I'm a big security buff, so it's a topic close to my heart. So I'm James Varga. I'm the CEO and founder of Direct ID. We're a global credit and risk platform. So essentially building a universal credit score, leveraging all that great power that we've just talked around open banking and the wealth of insights that you get from looking at someone's bank statement to help them get access to products quickly and easily. And as someone who's been involved in open banking for a long time, I started talking about it 11 years ago myself, and I've been involved in the open banking program quite closely in the UK. It's a typical conversation that comes up. Personally, I think it's when we compare open banking as a regulated activity, so we're all regulated firms doing legitimate things. We forget sometimes to compare with what we used to do, right? We used to send bank statements in the post to call centers in random areas of the country. So I think in context, digitally sharing, especially with that ability to just proxy the data, so not save it, as Ian said, is much, much safer and more secure and more consent driven, because you're controlling who gets access to that data than what we used to, if that makes sense.
Yep, thank you, Jamie. Sorry, thank you, James, for that robust defense of the data. I guess it is just something that I hear more from certain demographics. Maybe the older demographic in particular would have concerns around that. And the panel, those of you in the audience probably can't see James, but he is nodding away there. So there are some concerns out there. One of the other uses of open banking data can be around helping people to make better decisions, take control of their spending. Arcana, I think that's an area that you focus on. Could you maybe tell us a little bit if I have that right?
Hi, Laura. Yeah, you're absolutely spot on. Hi, everyone. I'm Archana from Snoop. So Snoop is a money management app that essentially gives everyone a consolidated single view of their finances. So we allow people to connect their credit cards and their bank accounts to Snoop. Then we give them a single view and help them really make sense of their financial situation. And we're able to kind of leverage open banking data, past spending data, to help people have a really clear idea of their financial position. And I think one of the things that kind of sets us apart is our the way in which we combine our editorial expertise with the kind of rich data that we have within the platform. And a good example of that is what we've done around the kind of cost of living crisis. So as we know, here in the UK, people are facing huge price hikes across all the kind of major bills. So one of the things that we do is we basically look into the price hikes for all the major bills, and we create a personalized price hike statement for people. So for example, if we can see that someone is spending £200 on their energy bill every month with British Gas, and we know that prices are going up 20%, we can give people a projected price of what they're going to be paying in the future. And I think that's a really powerful tool to help people manage their cash flow and really kind of prepare for some of those price hikes. And there are a couple of things that we do around kind of the poverty premium as well. I think one of the examples is around prepayment meters. So we know that people have two ways of paying bills here, either by direct debit or through a prepayment meter. And prepayment meters, the energy tariffs, they cost way more than standard meters, and it's often people on lower incomes that are maybe renting or have had debt in the past that are basically being penalised and are ending up paying higher prices. And what we can do within Snoop is we can actually analyse spending transactions to understand who might be on a prepayment meter, and then we can serve them content that tells them about how to switch to a standard meter, what the rules are around debt and switching. Another example is around insurance payments. So we know that people that pay for insurance annually upfront pay less than people that have a monthly payment system. So what we can do again is kind of highlight and identify those groups of people that may be paying in that way, and again signpost them to get help and information.
Okay, thank you very much for that, Archana. I'm sorry, I think I've been saying your name wrong, so apologies for introducing you somewhat incorrectly. I'm glad that you brought up the cost of living, and we touched on it a little bit earlier. Sam, I want to bring you in here because you're involved in, I think, through Silicon Valley Bank, you lend money to FinTechs who are lending on to customers. This is quite a scary time, I would have thought, to be lending to customers, since the economy is in such a strange place. Costs are increasing, there are job losses in certain sectors. The consumer, the Bank of England keep telling me, is under a lot of strain. So how do you think about that as you also want to grow Silicon Valley Bank's loan book through these new technologies?
Yeah, absolutely. Definitely is a scary time, especially if you don't have the data to hand, the live data. So when you're thinking about lending to consumers, and we've heard about credit rating agencies and how kind of traditional underwriting has excluded people, but one of the big issues is that the data received traditionally is historic in nature, backward looking, and things like defaults or arrears on payments or county court judgments in the UK don't appear for a significant length of time. So when you enter a really uncertain macroeconomic environment with the cost of living crisis, high energy costs, et cetera, you're kind of operating in the dark a little bit if you're using traditional methods of underwriting consumers. So actually, by using the more live data that we've heard about through open banking, you can really see, is there that stress? How is it impacting that consumer? So you don't just automatically turn off the taps and say, okay, we're operating a little bit in the dark at the moment. Everything is kind of scary. We turn off the taps to people that we know are not prime customers. Apologies for using that term. We're turning off the taps completely and there's no access to credit until we get a better visibility. So actually using that technology through the open banking data really keeps the taps on and gives people access to credit at the time they probably need it most in their life. I guess from a banking perspective is, how do we do that by supporting FinTechs like Jamie and Plend? And then what benefit does that actually have to the end consumer? Well, hopefully it kind of keeps the taps on, and furthermore, it should hopefully, if they get institutional financing from a bank such as ourselves or others, it might reduce Jamie's cost of lending to that consumer as well, and he can pass on the cost reductions to that consumer.
Okay, thank you, Sam. And that actually leads us nicely into our first audience question, which I'm going to kick to you, Jamie from Blend. Someone asks, and I would expect this is someone also working in the field or following it quite closely, for lenders that use both open banking and bureau data, how do you combine the two?
Sure. So, I mean, in broad terms, if I can use a musical metaphor, sort of bureau data is the minor note, I guess, in the composition. But essentially, if you've got warning signals from the bureau data, CCJs or defaults way in the past, or people who have had problems with credit, in the last 3, 4, 5 years, then you're looking for a stronger case from the open banking as the counterweight, right? So a strong case from open banking is someone who's been, you've got the reliable income coming from the same source that's been coming in for the last 12 months. They're paying all these bills that the bureau can't see on time. You can see if they're paying their rent on time. You can see that they're spending. They've got some seam allowance in their disposable income. A bit of kind of a fat, I suppose, to pare back on if things get hard. A bit of a buffer at the end of the month. And it also, the great thing about open banking is it gives you insights into risks that the bureau just can't see. So Sam there was talking about the early warning signals that you can get, return direct debits, credit stacking, things, these warning signals that basically won't appear on the bureau file until too late. But there are other kind of risk factors like gambling, for instance, gambling activity. So over 10% of all our declines are actually from excess gambling activity, and gambling is completely invisible to the bureaus. So there's positive signals that you get from the open banking data to sort of counterweight either the thin or the impaired bureau file, but there's also a lot of risks that you get from the open banking, and if those risks aren't present, then you've got additional confidence that you can either kind of discard kind of historical impairment, or you can rely on the open banking data because the bureau data is thin.
Okay, here's another somewhat technical question, Jamie. I think probably to you in the first instance, and then maybe James might have a view as well. What kind of cohort analysis has been done on lending books using open banking data? I think James Varga, you mentioned that you had some benchmarking, which I think may or may not relate to this, but Jamie, do you want to take a stab first? And then I'll kick to James. If anyone else fancies cohort analysis, please raise your virtual hand and I'll also come to you.
I can answer it in two ways. So one is the big kind of classic open banking off-the-shelf provider back in the day was called Credit Kudos, and Credit Kudos always used to say in their material that you could reduce default rates by 50% using open banking data, which is a bold claim. But they were purchased by Apple in March last year. So there's definitely something to it. They've clearly purchased them because they want to incorporate open banking into their Apple credit card that's coming into the UK. Apple clearly see that there's legs to open banking analysis. And when it comes to sort of the way cohort, the one thing I would say that's really interesting from Plend's point of view is that if you were to look at the traditional credit score curve and who we lend to a lot of people, I guess, who, if you're in the industry, you call it the near prime. And we do, some lending to the subprime, but we don't actually lend to everyone in Plend who has what would be traditionally called a really strong credit score. And that's because of those risk factors that we can see that are completely invisible to the bureau. So there's a lot of people who have classically strong credit scores, people who just use bureau data would be lending to right now, who actually we will turn away for a loan. So open banking isn't just about being able to lend to people who usually would be excluded from credit, although that's definitely the best use for it. It also helps you to understand risky people who actually have got strong traditional credit scores, but the risk factors are either invisible or they haven't appeared on the bureau file yet.
Got it. Thank you. James, I want to bring you in here on, I guess, a related point, which is around, I guess, frankly, how do we know this data works? How do we know that, because we've only had it for 5 years, and you and I have discussed this previously, we're not going to know if you're actually right about these loans until several years' time. So how can you be confident this data is actually predictive? And not just predictive, but I think you see it as being more predictive, particularly in this environment, than traditional credit file data.
Yeah, no, great question. And in a lot of ways, it depends on the country that you're talking about. Some countries have really strong credit reference agency or bureau industries, like in the UK and the US. Other countries have a deficit of that information. So the only option is to move to something like open banking to make a meaningful difference. Maybe the best way to answer is from two perspectives. One, from how our customers have used our data. And we have customers, one is in the US, if I think about it quickly. We've helped them help millions of people, so pretty big sample size. And their feedback to us was that Direct ID and the open banking data, on top of bureau data, credit reference agency data in the US, helped increase their issuing rates by about 45%. So when we talk about financial inclusion, that's 45% more people that weren't able to, as highlighted by Jamie, access those products previously at a lower cost and a lower risk. They reduced their overall fraud risk by 8%. Those are pretty massive numbers when you're helping millions of people. Outside of that, we've also done some benchmarking and some modeling based on performance modeling based on bank data-based credit risk assessments and bureau-based credit risk assessments. And all the G scores, all the insights that we've been able to pull back from that all show that open banking performs better than bureau. Now, there is no silver bullet. There's never going to be any one perfect solution for everybody, but combining, as Jamie has elegantly put it, combining the best of both worlds is really, really exciting times for us, right? We can broaden our reach into the market much better than any time before. And I think what we start to see is, as businesses, lenders start to use bank data, that they move their first stage from bureau to bank data. Initially, when people are using bank data alongside their process, they start with a bureau check first, and then they move to the bank data. As people get comfortable, we consistently see them start to switch that priority to use bank data upfront, first of all, to do that initial assessment, and then rely on bureaus and credit reference agencies for CCJs, PEPs, sanctions, all those AML, KYC, all those other bits of check that you also have to do to fill in the blanks almost.
And can I just ask, as the users get more comfortable and more familiar with this environment as well, how easy would it be for me to game my open banking data? So say if I open up a new bank account and I want to keep that bank account clean, so I do all my gambling on my payments app, and I basically keep a really artificially clean version of my life on the app, which I then give you access to.
Yeah, I would guess it'd probably be a little bit harder than gaming your credit score, which you can do today. I mean, you can engineer your own credit score if you wanted to, but I think the wealth of data in that bank statement prevents most people from doing that. It's not just around your gambling spend. It's about your income. It's about your predictive cash flow. It's about time series analysis, looking at how quickly you spend, how quickly do you go into overdraft, how many direct debits do you set up on your bank account, and that sort of thing. So the way I've always described open banking is your bank statement data is a reflection of you as a physical person, right? The only way to game that is to pretend to go to Tesco's and do your shopping, pretend to have a job with whoever. That's a very difficult thing to do. Nothing is ever going to be 100% secure. We live in that world. But I think open banking provides such a wealth of insights that it'd be pretty hard to purely game the system.
Okay, thank you, James. Jamie, I've got one more technical question for you. I think because you were the fireside chat, you're getting all these technical ones. Before I ask that, I want to ask all the panel, because this is going to be the only question I throw out to all of you, to think about if there were one thing that could happen that you think would enable open banking to be more impactful in financial inclusion in the UK. What will that one thing be? So I want to give you all a chance to think about that. While Jamie, I come to you with a question about, do you lend to the credit invisibles? I'm actually not sure what the credit invisibles are, so maybe explain that first to me and maybe the audience, and then tell us if you lend to them.
So I believe what the person means by credit invisibles is someone who literally has no data on their credit file at all. So a thin file would be someone who there's a limited set of data points where the data doesn't go very far back, and then invisible, I believe what they're saying is that there's no data at all. So you know, you can lend to very thin files if the open banking data is very strong, because you know that they have a file, and you know even that you don't have lots of data on the bureau file, but you know you've got visibility that there are no sort of impairments historically that you might want to be aware of. The problem with an invisible file is that they could be hiding a bad credit record, say at a different address or something like that. So you do need to find a credit file, but it can be a very thin file, would be my steer. Although, hey, you know, there are lenders out there who are lending purely based on open banking data. You know, there are some people who are trying that approach, but yeah, so far I would very much say, again, best of both worlds is to use bureau and open banking in collaboration.
Okay, thanks. And I will come back to you shortly with a follow-up question to a few of you about the tolerance for losses in this space. And given where rates are at, you have to have a reasonably high tolerance for losses. But first of all, we're going to come back to our question on what could be the catalyst for making open banking more impactful in financial inclusion in the UK. Lauren, I'm going to come to you first because of where you are on my screen.
Yeah, I was thinking about how, for the organisation, some on this call, and no doubt some listening in, who are already using open banking to serve more customers, I'd be thinking about how fully are you extending into people who are really struggling, really financially vulnerable, you know, borderline excluded, and if they're not in your target market or who you're willing to serve, either how do you get to a place where you can serve them directly, and if that's just never going to be in your, you know, in your plan, or not able to do that, how can you help organisations who do serve those customer groups? So credit unions and CDFIs, as said earlier, they're kind of non-profit organisations, which comes with the kind of the tech budgets you would expect of non-profit providers. So how can we say, actually, if we're not willing to serve the most excluded customers directly, let's put some of our spend into supporting organisations who perhaps could, you know, at discounted rates or with slightly different models.
That's an excellent point, Lauren, and hopefully some people on this call will take that on board. Ian, I'm going to come to you. What's your one catalyst, your one wish list?
My one wish list would be stronger sort of regulation and enforcement for financial providers to supply like true open banking and open finance connections in the UK. One problem we see sometimes, you know, with some users using certain products is that they say, oh, I can't connect to my bank. And that's often not on, no one's able to supply that because they haven't provided a proper true open banking API.
Okay, that's also an excellent point. Thank you for that, Ian. Archana, I'm going to come to you next. What would you like to see happen?
Yeah, similar to Ian, I'd love to see more banks on board with open banking. At the moment, it's just the CMA9 that are mandated to take part. I think.
And the CMA9 are, sorry, for the non-UK audience.
Yeah, sorry, the Competitions Market Authority have set out 9 of the biggest banks in the UK that have been mandated to take part in open banking. But there are some pretty big banking organisations that aren't part of it, and also lots of the challenger banks that aren't possibly. I think it would be amazing to see buy now, pay later providers on the open banking platform. Like we've seen in Snoop, a 75% increase in buy now, pay later usage. And actually, you know, there are people using multiple providers and they just don't have that kind of consolidated view of kind of payments they need to make and their kind of increasing debt commitments.
Okay, thank you so much. And I'm very glad that you actually mentioned buy now, pay later, because I do have some questions about how that data ties into your data. Before I get to that, Sam, and just to advise you guys of the order so you can prepare, it'll be Sam, James, and then Jamie. So Sam, what's your top thing that you'd like to see change or done?
Yeah, I think we've spent a lot of time talking about, actually having access to credit, and there's clearly a lot that still needs to be done, especially by the sort of traditional incumbent banks. But I think once people have access to that credit, it's really using open banking to assist them when they get into, or where there are signs or projected signs that they will get into difficulty. If there's any way of sending trigger alerts and building that kind of relationship with them, saying if you carry on this path, you will get into financial difficulty. That not only helps the consumer, but it also impacts the lender positively by building that relationship with that consumer and trying to help them make sure that they can repay that loan in future. That will reduce the cost of the loans. It will create a good track record for new fintech lenders, and eventually that will create lower costs for this consumer base. So really using the power of open banking data on an ongoing basis once people have already access to credit.
Okay, excellent. Thank you. James Varga.
Thanks, Sam. That set me up really, really nicely, because I don't know if my answer would be, I don't know if there's any one thing that is going to make a difference.
There's always one who won't give one thing, isn't there?
Well, yeah, but I feel like open banking is now on that critical mass, right? It's a big global trend. We cover 45 countries. We've got 13,000 connections with banks. They're all at a slightly different stage in readiness and all the rest of it. But for me, the next challenge is one of adoption. And that's not just in the origination onboarding part of the process, but as Sam hinted at, it's throughout that credit risk or credit life cycle journey that people go through. The getting access in the first time, the portfolio management, even into collections recoveries. That's a very stressful time for people if they end up in a default state or delinquent state with their product. How do we reframe some of that conversation? So I think if I were to answer, my one thing is around continuing to build really effective use cases that offer value to consumers and benefits to businesses. I think is the more value we can build from this data, and the more we can share the knowledge and see the impact and illustrate it, then more people will use it, and we'll be able to then keep the cycle going.
Thank you. Jamie, you have both the hardest and the easiest task. The hardest because, well, the easiest because I've given you the most time to think about it. The hardest because there have already been so many really good answers and you can't repeat them. So let's hear it.
I'll give a nerdy one around open banking first, which is that right now the majority source of traffic for all lenders in the UK is through affiliates, sort of your big comparison tables like your money supermarkets. That's where everyone gets their borrowers from. Those affiliates really just use credit bureau data to give an initial decision. And it basically means that if you just use bureau data in your lending, you are rewarded by having a higher spot on their table. So essentially, more people end up clicking on people who have higher rates but can give you a certain answer because that's all they connect to. And because we use open banking data, although we can give you a better rate, we can't be sure that we can give you the loan based on the data these guys use. And so, it just makes it harder to reach the wider audience in the UK that open banking deserves. So until open banking gets plugged into the wider sort of ecosystem, lenders who use kind of older, flawed, limited systems are going to be rewarded above people who are using a broader data set and offering a lower product. And more broadly, in the UK, full stop, I just think we need a lower daily interest rate cap, full stop, to protect people from the more predatory lenders. 0.8%.
And the current daily interest rate cap, just remind anyone who's not familiar with it.
Everyone knows, surely. 0.8% is the current rate, which doesn't sound like very much, but that actually means it's like a 300% a year or something like that. So there's an argument to be said that if you pull that down too low, you push people into the arms of sort of loan sharks and unregulated lenders. But I just don't believe that the sweet spot right now is 300% a year. There's got to be a better way. So I think that needs to be pulled down to protect vulnerable people from the sort of the payday lenders and how much they can legally charge. And finally, just to Lauren's point, totally agree that kind of wider engagement with sort of the kind of CDFIs and charity lenders is needed. So Plend actually does allow kind of values aligned CDFI lenders to use the open banking engine we've built free of charge. across. So yeah, I think kind of wider engagement with that space and giving them the tools who, you know, maybe couldn't buy, you know, a subscription to Credit Kudos back in the day is a really important way of kind of helping to tackle this problem too.
Okay, thanks so much. And we're into the final 10 minutes of our session. So we're now going to go into a rapid fire session on the audience questions, of which there are many, and also on my question on buy now, pay later. So Lauren, the first one's for you, because someone says, this discussion seems to be focused on easier ways to give people more credit. I would like to ask Lauren if she feels more could be done to find other solutions. I'm not exactly sure what they mean, but go for it.
Yeah, I guess to start by saying that, to your point, my belief is if people have a need for credit in the moment when, you know, something's happened in their life, but they can't afford it, we always say the washing machine breaking example is a good one, that there should be an affordable option for them. So it's useful to be talking about that, but totally agree with open banking and with other solutions is other things we should be looking at. So across all 6 of our financially vulnerable segments, we see a real passion for saving. So whether that's saving in terms of every time I get £1 in my purse, I put it in a locked cash box in my kitchen and I put the key back in the cupboard and those £1 coins add up, through to a more digital, it's on my, you know, Challenger Bank app and everything goes into the pots and it all rounds up automatically. People are really keen on building savings in a way that works for them. So I think definitely anything that can help people with the kind of the you know, people who really struggle to save with the small amounts that add up over time is really important. And then, yeah, I kind of touched on benefits calculators and grant checkers earlier. For our most kind of excluded lower income customers, how can we make sure that financial providers who can see the full view of their situation are doing everything they can to say, actually, we think you're owed either these kind of benefits or you might be eligible for these kind of grants, which can actually disrupt that credit cycle. You know, a £500 grant from, you know, a local authority that an open banking solution has helped to identify might mean that £500 credit, £500 loan is no longer needed.
Yeah, that's a really good point. I guess it also kind of comes back to the question around incentives, in a sense, in that, you know, a lot of the big traditional financial institutions are not incentivized to remove someone's need for credit because they make money from someone's need for credit. And you can't see, but Lauren is nodding there to that as well. I'm gonna bring in Arkna and also Ian on an audience question about, I guess, from a more individual perspective, asking, for an individual that feels overwhelmed in a negative financial situation, what's the first step towards turning this around? Arkna, do you want to go first on that one?
Yeah, I think there'll be an increasing number of people feeling this for sure, and it's definitely what we're hearing from our users at Snoop. But the first thing to do would be to get a really clear understanding of what your position is and really, really get to grips with your income and expenditure. And, you know, whether you do that through an open banking app or whether you just sit down and, you know, bash it out on a piece of paper, that's a really important step. I think the next step really depends on where you are. So for people that are potentially in debt crisis, so, you know, they're struggling to pay their bills, they really should go to one of the debt help charities, so Citizens Advice or Step Change, to get kind of one-to-one debt counselling. I think for other people, then really it's about kind of forensically going through your income and expenditure to see what you can do to reduce bills and kind of cut back on essentials. But I think in reality, because of the cost of living, you know, there will be people out there that have done everything they possibly can do and are still, you know, really struggling. And the best thing to do is really go to one of those debt charities.
Ian, is that the same kind of advice that you would give someone?
Yeah, I was going to say it's just not, you know, not sticking your head in the sand kind of metaphor. Just really truly understand your spending behavior, take a good look at it, and especially things around like regular payments. You can often identify sometimes some of these repeat payments that are coming out, which you don't, you know, which you can cut back on. I know that can sound easier said than done, but I think it's just having that real true understanding of your spending.
Okay, thanks for that. James Varga, I want to bring you in now on, I know you've done a lot of work around the modeling and the robustness of the data, and I wanted to ask, how, if at all, can you capture some of this buy now, pay later data? Because it seems to be well, in a sense, it can be reasonably helpful in terms of helping someone with a thin file to build a file. But then I guess in some senses, it could also be seen as a negative behavioral indicator if someone is routinely taking out credit to buy a £20 takeaway. So how do you, or are you able to, is there enough data available for you to build that in?
Well, I guess to Jamie's point earlier, there's good and bad about everything, right? So in buy now, pay later, really interesting area and topic, one which I don't believe the right answer is to take a traditional bureau approach to and look at that sort of historical data for the most part, as you said, it changes too rapidly, right? You know, everything, a lot of buy now, pay later or installment plans over very short periods of time. So by the time we've gone through that, knowing what you've got is almost irrelevant. We've done a lot of work to train our categorization engine to look at buy now, pay later as one of those core indicators of risk or behavior. So I think having buy now, pay later isn't necessarily a bad thing. Using it consistently and paying it back could actually be a really strong sign of financial control and the ability to manage your finances. But it's understanding that behavior, first of all, that is the critical bit. And how much does that behavior put at risk your financial situation? One of the other bits of insights that we have, or other models we have, is a predictive cash flow engine that is used in buy now, pay later propositions that use our platform to help look at the probability of default over the next few months. Because doing buy now, pay later isn't bad. Doing enough of it that you're not going to be able to pay your bills next month, that's when it becomes more of a risk.
Okay, thank you for that. Lauren, I want to bring you in on that point and also a related point. So I guess on that point, I mean, do you see buy now, pay later as being somewhat dangerous for the people who maybe can't get access to more traditional borrowing, but they can access buy now, pay later, and they end up spending, you know, they end up almost being lulled into taking out more of this debt because it's so easy in a way that, you know, other credit hasn't been for them?
Yeah, I have quite mixed views on buy now, pay later, because I think it's obviously been incredibly successful, which shows that it's serving an unmet gap in the market. So the fact that people are able to split payments for things that they couldn't previously afford, for millions of people, will be hugely valuable to be able to do that, and to do that without interest. So I think we're seeing the surge in the demand there really being driven by that gap. So one of my kind of more system-wide questions is how can we fill that gap in a way that's ethical and kind of won't lead to bad outcomes for customers? But for sure, it's very easy currently for people to just split those payments because they can, without perhaps looking if you're splitting, you know, several payments over several different buy now, pay later providers. What's the total cost to you? Does that look like over a 3 to 6 month period? I think people are going to be in cycles that are really challenging to get out of.
Yeah, for sure. And now we have an audience question for you as well, which is whether you're concerned that eventually those who choose not to give people access to their open banking data will be penalized, and could that lead to the financial exclusion of non-sharers?
Yeah, I'd say absolutely. Helen used the word data poverty. I think of it as more like a digital discount. The more you engage digitally on things like, we said earlier, direct debit, customers who choose a direct debit often get a better rate than people who don't. So this feels like potentially the next extension of that. The people who either can't connect via open banking or choose not to, perhaps due to trust issues, are going to be reliant on probably providers that have more manual services. We know one of the reasons to use open banking is it's kind of fairly low cost in a commercial model. If customers who are left out are reliant on, face-to-face operations or phone-based operations or branch-based, there's a higher cost for that, which means they're going to end up paying the cost of the interest rates that go with that for those services. So I would have loved to have come up with a solution in the time I'd thought about the answer, but I think definitely there's a risk there, and as a system we should be thinking about how we can make sure we're designing for people who might be left behind as much as for the people that we want to serve.
Thank you very much. Well, it's quite a tall order to come up with a solution in a 2-minute answer, but hopefully over the course of this hour-long panel, we have managed to at least explore some solutions which maybe some of the audience may take away and be able to go forward with, and maybe build some technology or build some products with the future that may tackle some of these issues. We are coming up to the hour, so we are going to wrap it up there. I think the discussion will be available online as far as I know, but Helen can tell us more about that. So for the time being, I would just like to thank you all on the panel. I would like to thank the audience for both hopefully staying online for this and for your questions, which hopefully we mostly answered. Thank you.
Laura, thank you very, very much. You asked our panel some searching questions. Thank you. And weren't they engaged? It's obviously a topic that really, really resonates with everybody. As Laura said, we will be sharing this discussion across all of our channels. So how can you help to shift the dial in open banking? Well, that is to share it with your own networks. Clearly, this is a hot topic. It's a topic that has resonated. I can see the audience numbers, so please continue to share it, and then the debate can continue. We had a question about the credit market, the credit information market review. If you want to see our community response, you can go to LinkedIn and you can review that. We've still got time before the submission date, and we can add your comments into that. Okay, so all that remains for me to do is to thank Laura once again. Thank you very, very much. And to thank the panel for sharing their insights and their expertise. I would like to thank my team as well. The OBE team work incredibly and tirelessly behind the scenes to make these types of conversations happen. So thank you to Kaylee and to the production team and everybody else. So all that remains is me to say thank you for you to tuning in, getting my tongue tied, and to wish you the very best of health. And I will speak to you soon. Bye for now.